So here's a question. What kind of company posts record revenue, grows earnings 44% year over year, and then tells investors it's actually going to slow down on purpose? That's Delta Airlines, ticker DAL.
You're talking about one of the most interesting earnings stories we've seen this quarter.
Without a doubt. They just dropped Q1 2026 numbers that had the street nodding, and then management essentially said, we'd rather protect what we've built than chase volume. That's rare discipline in the airline space.
It really is. You have a company firing on all cylinders from a demand perspective. Premium revenue up 14%, loyalty revenue cracking $2 billion in a single quarter. And yet fuel costs from the oil spike are forcing them to make grown-up decisions. They're flattening capacity growth instead of chasing top-line numbers.
And that's exactly why we're covering Delta today. This is a company at a strategic inflection point. Let's dig in. Delta Airlines was founded way back in 1924 as a crop dusting operation in Georgia, from literally dusting cotton fields to becoming the largest U.S. airline by revenue and market cap. Today, they fly about 200 million passengers annually on roughly 1,200 aircraft.
The business runs through two segments. Airline is the obvious one: passenger tickets, cargo, maintenance and repair services. But the second segment, refinery, is the Monroe Energy subsidiary in Pennsylvania, and that gives Delta a structural fuel cost advantage over every other major carrier.
The hub network is a fortress. Atlanta handles more passengers than any airport on Earth. Add Minneapolis, Detroit, Salt Lake City domestically, plus international positions in Amsterdam, London Heathrow, Paris, and Seoul.
But the real story is the revenue mix. Premium cabin revenue actually exceeded main cabin revenue for the first time in Q4 2025, and that trend accelerated into Q1. The American Express SkyMiles partnership generated over $8 billion last year and is tracking toward $10 billion by 2029.
That's money that flows regardless of whether people are actually flying. It's a cash machine built on top of an airline.
Exactly. And the moat is a three-legged stool: the Amex loyalty engine, the Monroe refinery saving 4 to 11 cents per gallon on fuel versus competitors, and best-in-class operational reliability that drives customer loyalty and premium pricing power in a self-reinforcing cycle.
The why now is clear. Record Q1 adjusted revenue of $14.2 billion, beating estimates by $260. Adjusted EPS of 64 cents grew 44% year over year. The premium engine is humming, and management is showing the discipline that separates great airlines from average ones. Ed Bastian has been CEO for 10 years now, since May 2016. He's a 30-year Delta lifer who came up through finance, VP of Finance in 1998, CFO in 2005, President in 2007, and then the top job.
The street respects Bastian enormously. Named to Time's 100 Most Influential People in 2025, received the Tony Janus Award, the airline industry's highest individual honor. Under his watch, Delta became the most profitable U.S. carrier.
What stood out from the Q1 call was his tone. He pointed out that tariff uncertainty that froze spending last year has become background noise. But on fuel, he was refreshingly honest, deferring full-year guidance until there's clarity on oil. No overpromising. That's Bastian in a nutshell.
So let's get into the numbers. Delta's trading at $72 with a market cap of roughly $47 billion. The forward PE sits around 9.5 times, making it one of the cheapest large-cap industrials with this kind of growth profile.
Price to sales of 0.73, price to book at 2.3, and free cash flow per share north of $6.
Trailing 12-month revenue is $65.2 billion. Q1 total operating revenue was $15.9 billion, up 13% year over year. The adjusted figure was $14.2 billion, still a record. Gross profit was $4.5 billion and EBITDA $1.1 billion.
Operating income at $501 million looks lighter than you'd expect.
That's the fuel story showing up. Operating expenses rose 14% year over year, driven by higher fuel costs and wage inflation from new pilot contracts. Adjusted operating margin was about 4.6%. But Q1 is historically Delta's weakest quarter. Last year's Q1 margin was around 4%, so they're right in line.
The EPS picture tells the growth story better.
Adjusted EPS of 64 cents crushed last year's 44 cents. That's the 44% growth headline. GAAP was a loss of 44 cents per share, but that's entirely from $550 million in non-cash investment losses, not operational weakness. On a trailing four-quarter adjusted basis, you're looking at $6 to $7 of earnings, which supports that forward PE in the 9 to 10 range.
Cash flow is where Delta really shines this quarter.
Operating cash flow of $2.4 billion in their seasonally weakest quarter. Free cash flow of $1.2 billion after $1.2 billion in capex. On a trailing 12-month basis, free cash flow is about $3.9 billion. The balance sheet is in great shape too. Cash of $5 billion, debt down to $14 billion from pandemic peaks, equity of $20 billion.
That's a dramatic improvement from where they were 3 or 4 years ago.
It really is. The debt-to-equity ratio is about 0.7 now. Current ratio at 0.42 is low but typical for airlines since advanced ticket sales generate cash that doesn't appear as a current asset. Overall, Delta's financial health is strong. Record revenue, robust cash generation, and debt back pre-pandemic targets.
What's the street saying about all this?
Strong buy consensus, 24 buys and just one sell out of 25 analysts. Average price target of $79.26, about 10% upside. The range runs from 48 on the low end to 90 at the top.
Who came out swinging after earnings?
TD Cowen raised to 84, citing fuel resilience and the refinery hedge. UBS has the highest target at 86. Argus bumped to 85. Evercore held outperform at 80, pointing to moderating capacity as a positive for industry pricing.
And the Q1 report itself, both beats. Revenue beat by 260, EPS beat the 58-cent consensus with 64 cents. Q2 guidance was low teens revenue growth, operating margin 6 to 8%, and EPS of $1 to $1.50.
That EPS range came in below the street's initial $2 estimate. But that's entirely about baking in higher fuel costs. Bastian was transparent. He'd rather give guidance he can beat than set a bar that depends on oil he can't control.
All right, the bull case. It starts with premium revenue. This isn't a cyclical blip, it's a structural shift. Premium revenue grew 14% and now exceeds economy. High-end consumers are spending on the experience economy, regardless of macro headlines.
Add in fleet modernization, A321neos and A350-1000s coming online this year, with 20 to 30% better fuel efficiency on new routes. And the Amex loyalty flywheel, generating $2 billion a quarter, growing 10% year over year, providing revenue that's decoupled from oil and weather.
The third bull catalyst is management discipline. Bastian's response to fuel uncertainty wasn't panic. It was flatten capacity, protect margins, let the premium product speak for itself.
Now for the bear case, and it's straightforward. Fuel. Oil spiked from the Iran conflict, and Delta's fuel bill could increase by $2 billion in Q2 alone. That's a margin killer, and the Q2 guidance miss versus initial consensus proves how vulnerable even the best-run airline is to energy shocks.
What about the consumer?
That's the second bear point. Bastian himself said the lower-end consumer is struggling greatly. You've got a K-shaped demand environment, premium booming, economy soft. If that bifurcation widens, volume could disappoint. And rising labor costs from new pilot contracts are structural headwinds that don't go away.
The bulls counter with the Monroe refinery providing $300 million in Q2 alone, plus the capacity discipline protecting pricing power.
Fair point, but at 9.5 times forward earnings with a beta of 1.31, the stock still amplifies market moves on the downside.
Against the competition, United trades at about 11 times forward on a $31 billion market cap. Stronger international exposure, but higher geopolitical risk. American Airlines sits at $7.5 billion on $54 billion in revenue. Price to sales of 0.14, basically trading like a distressed asset.
And Southwest at $14.5 billion is a different model entirely. Among the big four, Delta's combination of margins, loyalty revenue, and operational reliability makes it the clear quality play. You pay more per dollar of Delta revenue because it's stickier and higher margin.
The options market shows a put-call ratio of 2.05, looks bearish on the surface.
But context matters. Implied volatility percentile is only 19, premiums are near their 12-month floor. That elevated put-call ratio is portfolio managers buying downside insurance, not a conviction bet. Puts cluster at 65 to 67.50, calls at 75 and 80.
With IV this low, options are relatively cheap for anyone looking to position around the next catalyst.
Agreed, but we'll leave the strategy decisions to you and your advisor.
On insiders, about $10.3 million in sales over the past 3 months. EVP John Laughter sold 69,000 shares on April 10th for $4.7 million right after earnings.
Standard post-earnings executive selling. No insider buying, which some flag, but the absence of buying in a rising stock isn't necessarily bearish. Executives sell for liquidity all the time.
The biggest risk remains fuel volatility. If oil doesn't stabilize, every quarter's guidance becomes a moving target. The K-shaped consumer and rising labor costs are structural headwinds too.
And tariff escalation could raise aircraft costs, slowing fleet modernization timelines.
But the key metric to watch is Q2 operating margin. Management guided 6 to 8%.
If they hit the high end despite elevated fuel, the margin protection thesis is confirmed and the stock likely re-rates toward that $79 consensus target.
Here's the bottom line. Delta is the highest quality operator in the U.S. airline space. Record revenue, premium exceeding economy, the AMX loyalty machine, operational reliability that drives pricing power, and a management team that responds to adversity with discipline. The risk is fuel, full stop. Everything else is working. At 9.5 times forward earnings, the market is giving you a discount for that uncertainty.
And if oil doesn't stabilize, the refinery hedge and capacity discipline provide a floor that competitors don't have. The risk-reward setup here is genuinely asymmetric in Delta's favor.
I'll leave you with this from David Zipkin, co-founder of Tradewind Aviation. I think the pendulum swung too far towards bare-bones economy, and it created a pent-up demand for a higher level of service.
That captures the Delta thesis perfectly. The pendulum swung and Delta was the first mover.
That's going to do it for Charged Alpha's deep dive into Delta Airlines, ticker DAL. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
And I'm Lana Chen.
We'll see you next time.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.